All right, my name is Jason Gordon. I'm an Extension Forestry Specialist with Mississippi State University Extension, and I will be discussing casualty loss as part of our extreme weather event program here for YouTube. The reason we're bringing up casualty loss and the tax implications for casualty losses after an extreme weather event is because it ties into the landowner's ability to be resilient and to increase resilience and bounce back after an event occurs. And this is just one of the tools among all the different tools you're listening to pre and post disaster that will allow you to bring back. And our intention for this, our goal for this is, as foresters, is that you get back on your feet and you're able to salvage as much of that product as you can, and then also replant and start your forest management again following that catastrophic loss. I am not a tax specialist. I'm a forestry extension specialist, but I do not focus on taxes. So I wanted to put this name up there, Linda Wang, who's with the U.S. Forest Service, and she's the National Tax Specialist. So if you have further questions, she's a very good person to talk to. And then, of course, we have some tax people here with MSU Extension who you can contact as well. So concerning casualty loss, there's several different types of losses. Casualty losses are deductible losses. Now, not all losses are deductible, so that's one of the things you've got to figure out if after an extreme weather situation and your timber has been blown down or that kind of thing, or wildfire has gotten a hold of your timber. You got to think, is this a deductible loss or not? The other thing you've got to think about, there's several considerations, is you may not have to get a forester out there to do evaluation of your loss. Is it worth it? Is it worth hiring the CPA? Do you have enough loss to make all this financially balance out in determining these deductible losses? Because you don't always get a positive response from the IRS. You don't always get to that casualty loss deduction. It depends on several different factors, which we'll talk about here in the presentation. The casualty loss, which is a deductible loss, is when timber is destroyed, stolen, or condemned. And of course, this being an extreme weather program, we're going to be focusing on timber that has been destroyed. However, stolen timber, timber theft, and timber that has been condemned for some kind of public use, such as a widening of a roadway, follows the same pattern as when timber has been destroyed in terms of communicating with the IRS about this loss and recovering from that loss. These are all known as involuntary conversions, in contrast to a voluntary conversion, which would be a harvest, a timber harvest, for example. And like I said, there may be little or no deduction. And we do this program all the time, and we do this program after extreme weather events, and landowners can be disappointed, can leave disappointed because they figure out that they do not have the option for declaring a loss, and they do not have the option for getting a deduction of their taxes. So there's a number of different variables you've got to think of about for this. Like I said, there's several different types of losses we've got to consider. There's normal losses. And I have here on my slides, you'll notice an exclamation mark up on the top left corner. And what that means is that's a term that I want you to walk away from this program with. Those are the especially important things to know. Normal losses are what's expected from growing trees. That's why we start by growing several hundred trees, and some of those trees die off through that growth process. We know that there's going to be that kind of loss. That would not be considered a deductible loss. That's a normal loss. So overcrowding is one kind of normal loss. Routine levels of insect infestation is another kind of normal loss. There's always going to be some Ips beetles and some other bugs in there, and you're always going to have a little bit of loss, and you can't declare that for a deduction. Routine disease as well, such as rusts, for example. Low rainfall, some short-term droughts would be another normal loss, something that we just have to expect because we're growing timber and there's a risk in growing timber. And these are not deductible. Now, when we say low rainfall, we're not talking about an abnormal drought. That falls into another type of loss category. What qualifies as a casualty loss then? So you see the exclamation point and you see those words in bold. It must be a sudden and specific event, and it must be unexpected and unusual. So what are some examples of that? Katrina might be an outlier, but that's a very good example of a casualty loss event. A big wildfire would be another example. An ice storm would be another example. Compare that with your normal losses, which are losses that we can expect, and they're not necessarily sudden. The drought, short-term drought, creeps up on us, and eventually some of those trees die. Also, a casualty loss is defined as a natural or external force, and it leaves your asset, that is your timber, unfit for use. But those key terms, a specific and sudden event, and unexpected and unusual, and oftentimes with casualty loss, and this is one of the things we'll talk about as far as providing evidence of the casualty loss, it will be published in a newspaper or on TV. That event will be, the date and time and so forth will be publicly available. So then you have non-casualty losses as well. And this is when timber died from unusual and unexpected events, but not necessarily sudden. Unusual and unexpected, but not sudden. This might be an outbreak of southern pine beetle, which we have occasionally. Emerald ash borer is coming down the pike. That might be an example of that. Unusual and unexpected, different, not like Ips beetle, but it comes in slower. And drought is one that I said we'd come back to. A prolonged long-term drought, such as that's been recognized in recent years, especially droughts that are recognized as a disaster, usually by the Secretary of Agriculture or other high government officials, would be recognized as a disaster, and you could claim a deductible loss. But these are non-casualty business losses, which means that you have to have your tree farm set up as a business in order to take this deduction. If you're a hobby owner, which is what the majority of our forest landowners are, and you have not shown in your tax forms that you're running growing these trees as a business, you would not be able to take a non-casualty loss. Scale matters. Like I said, do you have enough volume to make this loss worthy of declaration to the IRS? If it's just a few trees, it's probably not worth the effort of determining that loss, hiring the forester, hiring the CPA, so on and so forth. You got to have enough to make it worthwhile. Fair market value loss requires the estimation of loss and fair market value for the single identifiable property, or the SIP, which we'll discuss here in a minute. And basically what that means is that we're talking about the net loss. They might have a few trees in one section of your tree farm. We're going to declare a loss in the larger section, even if some of those trees are not necessarily damaged by the disaster. And that's part of your SIP. What kind of documentation is required? You want to have pictures, the documentation and loss of fair market value. That's where your forester comes out and does a reassessment of how much volume you've lost. Documentation of the basis in timber, and this is key, and this is why I said a lot of people will walk away disappointed that they can't make a deduction, because you can't make a deduction without a basis in timber or in the asset. Why do we have to document the basis? Because the amount of the deductible loss is either the loss in fair market value or the basis, whichever's less. Okay? Government's not going to give you more than it has to. So they'll give you whatever's less, your basis or your fair market value, the loss in fair market value. Basis, in a nutshell, is the investment value of the asset. How much have you invested into growing that timber? Okay, there's 3 ways to acquire basis, and we do have, through MSU extension, we have some good publications that get into more detail about basis, what it is, and how you acquire it. There's 3 ways of acquiring basis. The first is the initial basis, which is set when that asset, the timber, was acquired. It's often called the purchased cost basis. You also have the gifted or carryover basis, and then you also have, third, the inherited or stepped up basis. So purchased, when the timber was purchased, that would be the cost basis. That's your investment, whatever you paid for that. Gifted, when the timber was gifted to you, that would be the basis would be from the person who, the previous owner to you, the gifting of that basis to you. So it'd be the same basis. And then if you inherit that asset, that's known as a stepped up basis, which is the basis from the previous owner stepped up to fair market value at the time that it's newly acquired. Adjusted basis is the basis that is adjusted over time, that investment over time, as timber is sold or timber is destroyed or stolen, because you have lost some of that investment. So your basis becomes adjusted. When you declare a casualty loss with the IRS, you're declaring an adjustment to that investment that you made in that timber. And of course, again, this is all done in the SIP. Basis will not exist when the timber grew naturally, or if it was purchased after a clear cut. Why is that? That's because you haven't actually invested anything into growing that timber. It's grown naturally. Basis doesn't exist when the gifted property does not have a donor basis. Remember, gifted basis is the basis that transfers from the previous owner to the new owner. Well, if the previous owner doesn't have any basis, the new owner will not have basis. There's no basis when the inherited property, in the inherited property where timber was clear cut and the basis has offset sale proceeds, or when it was unused on a timely return. You have to declare your basis when you acquire that asset. If you don't declare it, you don't have the basis. And then it does not exist when the forest was established after acquisition and all costs were deducted using special recovery rules for reforestation. So that's basically certain types of government, financial government assistance dealing with reforestation expenses, which is being talked about in another presentation. That will change your basis as well. That there's no basis if the government is helping you with the investment. What happens if you don't have basis? You can do a retroactive establishment of basis. You get your forester out there and he does some measurements, and looks at the price of the timber at the time it was acquired, and that's how, in a nutshell, how a retroactive basis is established. You have to have a professional out there to do it for you, and you'll have to pay that professional. Can't do a basis if the timber's already been cut, or if there's no records available as to what that timber was at the time that it was acquired. Now, keep in mind, I said you can hire a forester to do a retroactive basis. That's an investment into that basis. Keep that in mind. All right, so here's an example of basis. There's a farmer, his name's Farmer Jones, and he acquires a farm for $100,000. On that farm, there's 50 acres of cropland and there's 50 acres of timberland. So the total available for basis would be $100,000. So that's what he invested in that property. All right, so he's got to figure out what basis he can allocate to timber, what's the basis he can allocate to his cropland, and so forth, and as well as any other assets he might have or structures he might have on the land. All right, so the market value for the cropland is $1,700 per acre, while the market value for the bare land is $100 per acre. He hires a forester to do a retroactive cruise and finds that the timber is valued at that time at $25,000. So you add all that up according to the acreage, and his fair market value of everything is $115,000. Remember, he paid $100,000 for it. Fair market value is $115,000. Basis allocation. This happens, step one, you total the fair market value of all assets in the property. That's what the $115,000 is. The second step is to determine the proportion each asset contributes to the fair market value. And then number three, you multiply each asset's proportional share against the original cost or other basis, the original cost being the $100,000. All right, so you might want to pause your video here for a second and look through this chart. He has his cropland, if you remember, totals out to $85,000. The proportion of the fair market value is 74%. All right, so allocated to the available basis, which is the original investment, would be $74,000. And you see that with bare land and with timber. So timber was worth $25,000 after the retroactive cruise. That's almost 22% of the fair market value allocated out to the original investment. It's $21,700. So the basis for his timber is now $21,700 at this point. Remember that I said that he hired a forester to do the retroactive cruise, and that is an additional investment into his basis. So he can, and he paid $1,000 for the forester to do that cruise. Cruise is an inventory of the timber. He can add that $1,000 back into his timber basis account because that was an investment into establishing the timber basis. So he adds that into the $21,700. So his new basis, his adjusted basis with the timber cruise is $22,700. Okay, getting back into casualty loss. Big storm comes along. Remember, the forester determined the fair market value before the storm, and then he comes back and determines it after the storm. Before the storm, this is a few years after Farmer Jones has purchased the property, he determines that the timber is worth $30,000 at this point before the storm. After the windstorm, the timber is worth $24,000 because so much of it is destroyed. What is the amount of the casualty loss? Remember, I said earlier that casualty loss is the lesser of the decline in fair market value caused by the casualty or the basis in the timber. Good thing he went out and had the forester establish the basis, because if there is no basis, he could not make any deduction. So those of you who do not have basis in your timber and you're not working with a forester, now would be a great time to go out and hire a forester to establish your basis. Generally, if total destruction occurs, this is the salvage value. Okay, what you can possibly take out, the wood you can take out of that destruction, and hopefully make some money off of it. All right, so his basis in timber, if you remember, with his retroactive cruise was $22,700. He had a loss in fair market value of $6,000. The lesser of the two is what he can deduct as his loss. So that would be what? The $6,000. How much can be of the basis can be deducted? This all depends on your SIP. SIP goes back to Mount St. Helens back in the 1980s and the destruction in timber caused by the Mount St. Helens explosion, and it became a big lawsuit as far as how much certain timber companies could declare as a deductible loss, and they came up with this idea of an SIP. And the point of an SIP is that not to have an additive method. And in short, an additive method is valuation of each individual stem, when in reality, the entire specified area of the stand is going to be impacted as far as its fair market value. All right, so I'll give you 3 examples of establishing your SIP. This is the owner defines his or her SIP. And these are very different kinds of examples to try and get the point across. The first one is fairly normal. John has 2 tracts, and he has a basis account in each tract. So each tract is its own SIP. His buddy, Fred, has 2 tracts, and he only has 1 basis account, so both tracts make up the 1 SIP. Why are they doing different things? Because they think it's better for their management. That's the way they want to do that. They have to have some kind of justification for it, but you can make justification like Mary has for fairly strange ways of defining your SIP. And Mary has 1 tract of timber. She wants to do something completely different to show you, the audience, how you define an SIP. So her basis accounts are set up by product. She has an SIP for walnut saw logs, walnut veneer, oak hickory. She has 3 SIPs. It's just the way she wanted to do it. She talked with her forester, and they both agreed that was the best way for her to do it, to define her property. All right, so can I include, remember Farmer Jones' example? He had the cropland, the timberland, as 2 separate assets. You cannot combine those assets. Land basis is separate from your timber basis. It cannot be used to increase your casualty loss deduction. Salvage or a good faith attempts at salvage is required for the deductible loss. And you have to document those attempts. It's really difficult to salvage the timber for a lot of people after a storm, particularly after those large storms when everybody else is wanting to get their timber salvaged. There's not enough loggers out there to do the job. If you're not on the phone immediately after that disaster, you might have to wait many months, up to 6 months or even more, in order to get that timber salvaged. And by then it's oftentimes not good enough to salvage anyway. So you document all your phone calls to foresters, to timber buyers, loggers, to your extension agent, and to anybody else who you are contacting with this situation. Document all that. Take newspaper clippings of the event, any kind of evidence you might have. Just save everything in a file, and because you will need that to declare your loss. And remember, all that goes into also showing that you have attempted to salvage your timber. What's the reason for that? It's because the government wants to see that you have attempted to make the best use out of that damaged timber, and that you are active in your management and getting your forest back into a good condition. Okay, so there can be a tax on salvage income. That's known as income. If you make money off of that damaged timber, they come in and they take it out for whatever product, chips or whatever, then you'll be taxed. Net taxable income is gross income, unless income less sales expenses and your basis, of course. And this is usually a long-term capital gain if the timber is owned at least a year and a day, otherwise it's ordinary income. You can postpone, this is key, you can postpone paying tax on your salvage income by purchasing suitable replacement property with the proceeds of that timber sale, of that timber salvage sale. And you have 2 years to do this. You submit to the IRS in your declaration year what we call a 3P form, plain piece of paper, and it says, what do you plan to do with this income? So we'll talk in a minute about what you can purchase, but it has to be related to forestry and to that timber, regrowing that timber. So again, you have to notify the IRS, attach a statement to your tax return, and follow up with a statement when your replacement is purchased. Tell the IRS that you've completed this. Remember, you have 2 years to do that. So what can be replacement property? Timber, obviously, timberland, reforestation, expenses, site preparation costs. You can even buy up to 80% voting stock in a timber corporation. All of this is with the goal of continuing to be involved, participate in the timber growth, the forestry industry, which is an important value to society as a whole. So we want landowners to continue this. When can casualty loss be deducted? For presidentially declared disaster areas, the deduction can be taken on the preceding year's tax return. You have to file an amended return. Now, you have to consider if your tax bracket has changed and your other financial situations and how much that would cost to file an amended return if you do something like that. Otherwise, it would be claimed with the current year's return. All right, so I'm going to go over some forms. This is where you might want to pause your video and possibly even print out this information. But it's fairly straightforward. What are the forms you would use to declare a casualty loss? Remember, we have 3 types of business structures for a forest landowner. You have the business owner, which has proven that he or she manages his timber as a business and looking for income. Farm owners are in kind of more or less in the same category. So for business owners, you use Part 2 of Form T. Form T is timber, T for timber. That's called the Forest Activities Schedule to claim basis depletion. You use Form 4684, which is the Casualties and Thefts form. And you fill out Section B for businesses, transfer that calculation to Form 4797, which is sales of business property, net gains and losses, and then finally transfer all that to Schedule D of the 1040 if there's a gain. Remember, you got to file the 3P form if you're deferring paying tax on any salvage income. All right, for investors, which is another category, you use Part 2 of Form T, timber form, to claim your basis depletion. Again, 4684 of the Casualties and Thefts Section B is where you declare what your casualty loss is. Then you enter your loss, transfer that to Form 1040, Schedule A, line 27 under miscellaneous itemized deductions. So the point here is that for business owners versus investors, there's slight difference in where you enter your information. So you must be careful about that. Make sure your CPA understands that. And then, of course, you on your 1040 Section D and Form 8949 for investors, you indicate your gain if there's a gain. And you file a 3P form if you're deferring paying tax on that gain. Hobby owners are in a little bit different situation. They're not managing their property for a business or as an investment. They do use Form 4684. That's where they report their casualty loss under personal use property. And then they transfer that onto 1040, Schedule A, line 19. That's bolded and underlined, casualty theft losses. For investors or business owners, you would not want to claim a loss on line 19 of Schedule A. This is only for personal property losses. And why is that? Because you can end up losing quite a bit of money. The amount of personal property losses are limited by $100 per casualty event and then 10% of adjusted gross income. So the lower your income, the less you're able to claim as a casualty loss. This also becomes more complicated and hurts more with all of our co-owners that we often have in forest lands. So you want to, that's one of the downsides of being a hobby owner versus being a business owner or an investor. And that is a quick summary of considering casualty losses and bouncing back from a disaster event to continue growing timber. We have here on this slide 2 resources for you. Again, we have a number of tax publications through our MSU extension website, but you can also go, if you want some very exciting reading, go to the IRS website and look up Timber Casualty Loss Audit Techniques, which is a about that thick of tax information on timber. Another good resource is timbertax.org, which is where we compile, we get all of our information from there. And that gives you a lot of detail and has a lot of educational tools for learning more about timber taxes and casualty loss in particular. Thank you.